Whoops-a-daisy, looks like the market just slipped on one great big banana peel at the very end of the day. So what the hell just happened? Hello everybody, my name's True Demon and I'm the Devil's Stockbroker. In this video, I'm going to be covering the market, overviewing everything that just happened on today, which is Thursday, February the 16th, 2023. In this video, what I'm going to cover is a full-blown explanation as to why the market just rugged everybody at once and where we're going from here. Be sure to stick around to the very end of the video where I will cover individual tickers on the SPY and elsewhere and let you know exactly where I'll be placing my bets for the bear market leg to come. Thank you guys for tuning in. Have a hell of a time in the stock market. The market started off the day extremely strong and ended the day with a massive rug pull like I have never seen before. This entire day, I've been watching the entire market performing more or less pretty choppy. I was expecting there to be a bit more of a reaction early on today after the massive drop that we saw with this gap down here first thing in the morning. SPY gave up about 125 points from the market open with this massive gap down. Pre-market looked really ugly for the SPY, SPX, and the Qs, but it came back and ended up pretty green on the day, making a lot of traders believe that we were going to see a big market recovery at the last minute, and it was going to reattempt to break out of this giant bull flag that we have been creating over the last 2 weeks in February. But at the very end of the day, this absolutely ridiculous, catastrophic collapse pulled the SPY down by a full 100 points within the span of about an hour and a half. So that being said, Power Hour brought some just absolute massive pain to the market right at the very end. Um, and I'm sorry to be so amused by it, but this is something that I was trying to warn everybody, like, this is coming, this is almost here, the volume is drying up, the signals are there, like, everybody should be paying attention, and all I kept hearing was perma bear, you have no idea what you're doing, you don't know what you're talking about, the market is going to recover, blah, 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 blah. And now all I can say is, like, I'm sorry, but I told you so. And it's not like I like being right about this all the time. I just want to help people. But here we are. So now let's go ahead and analyze what exactly happened in the market today and go over some of the news and some of the catalysts for why this may have been. So going over to the daily chart, we can see that overall the market has so far broken out of this megaphone pattern that the SPY was creating during the entire duration of the 2022 bear market. And this market breakout here out of the megaphone is what signaled to most people a big market recovery. What I was concerned with was that we didn't see any fundamental drivers for why we should be bullish. And, you can argue that in modern trading, fundamentals don't matter, but at the end of the day, companies have to make money or they aren't actually doing anything except losing money. So you can't have a company continuously soaking up cash from investors and the value just keep going up and up and up forever. It doesn't work like that. So all these companies that are just the biggest names on the SPY that have been pushing and pushing and pushing in value without a fundamental driver, it doesn't really make sense. So that's exactly what's been happening for the last 2 months since the middle of February, the middle of December. Just the market got extremely bullish for no true explained reason. The only thing that we saw was that CPI came down in January and everybody was super excited with that outcome, which fair enough. But as you see that the market has gotten carried away, there's no other fundamental reason to be excited. So most of the earnings that were announced for big companies like Amazon, Apple, NVDA, Netflix, none of them were particularly good. Most of them were actually really bad, and yet the price of the market kept going up anyway. Crypto started coming back. Bitcoin kept surging. Bitcoin's big push for 25,000 was a bit of a shock to myself, and I'm not surprised that it's coming down in spectacular fashion. We actually have this giant shooting star candle right here with a huge top wick on this red candlestick after a massive engulfing green candle that took this entire range out of for the last month. And now that we got back above resistance, everybody was so sure that the market was going to continue, and now we're re-entering back into that range after the market just got pushed by relatively low volume. Compared to the last several months in Bitcoin, this volume is super tiny. So it is not really a good explanation for why the market is just pushing the value up of Bitcoin by 9.5% in a single day. Doesn't really make sense. That was more than these three candles combined in a single day, but with less than a tenth of the volume. Again, it doesn't make sense. There's not enough trading happening at these levels. Nobody wants Bitcoin at $24,000. Anybody that thinks that it's that valuable right now with the recession that we're facing is really not thinking clearly. And I'm sorry to be so blunt about it, but all the signals just don't look good. It just doesn't look good. We have bearish divergence on the RSI. We have MACD crossed down once already, and now we're getting ready to do it again after this big move. I'm betting that we'll just come crashing back down after Bitcoin crosses back below its 200 period EMA daily. If we do end up coming back down and collapsing back to the simple 200 moving average, then I guess that will be enough of a signal to communicate to everybody that the crypto market has not in fact recovered, and everybody is just speculating based on this golden crossover of the 50 and 200 EMA. It's normally a bullish signal, but in this market, it just there's no reason to be this excited about crypto when all of the major financial institutions that were driving its value and backing it up are now trying to dump it as quickly as they can without completely crashing the market with and themselves with it. So how did I even know that this was happening? It's this chart right here, SPY over HYG. This is the number one chart that I rely on for all of my big market signals. Every time I see a top in the market, it's always pinpointed based on the MACD of this exact ratio chart. So every top in the market that I have ever played, here down here, the third bar chart or candlestick chart on this is the SPY. This one right here is the HYG or the high yield grade bonds, and then this is the ratio chart of SPY divided by HYG. And the purpose of this is to show you the oscillations in the market of what the smart money versus the dumb money is. HYG is the smart money or the institutions, and SPY is the dumb money or the market participants. And by and large, you'll find that the smart money knows what's going on long before the dumb money does. Well, you'll notice every single time there's this big sell-off that happens in HYG right before the market collapses, and it usually leads it by about a week, maybe 2 weeks, depending on how market news and catalysts cause things to shake out. We had the same exact thing happen in August. There was this big sell-off that was happening days ahead of the top that occurred on August 16th. All the institutions started dumping their positions, and you can see it in the high yield grade bonds, but you don't necessarily see it in the SPY. And while SPY is going up, all the bond traders are selling their positions. So this is how you detect that. And we just had it again. You look at HYG going down like this and breaking down on a ascending wedge while the SPY was going up and up and up and kind of like barcoding to the side here over the course of the last 2 weeks. SPY going sideways while the HYG is just absolutely hemorrhaging money is a big signal that we're at the market's top. It's a giant giveaway. And you can see it more easily by looking at a MACD chart on SPY over HYG. So this MACD is for the ratio chart itself. And note this crossover happens at damn near perfect timing or when the market has topped. Notice the market top always happens the day before the crossover occurs. And today it got so close, so close today. It's almost ready to cross over. And for me, that's good enough. I've seen what this ratio chart does every single time, and this is good enough for me. I don't need to time it perfectly. This is close enough. And the way that the market has been shaking out with this giant bull flag here on the SPY, I just feel it in my gut that this is going to collapse and break down. And when the bottom of this bull flag breaks down, it will invalidate the entire market rally, and what you'll end up with is one giant head and shoulders. Let me show you my point. If I go back to the SPY and I come back and let me just put this on a naked chart, just go ahead and hide everything. You have one shoulder right here and the head of the market right here. And what I expect to happen is once the market retests this low, we'll get one more attempt and then come up with a much lower shoulder, not even breaking back to 400 before we come back down. And then we watch the market just drop from there. So that's precisely what I expect to happen. Market shoulder, head, retest the low, reattempt a breakout, fail, re-enter into this megaphone pattern. And once we're back into this megaphone pattern, we're heading down, baby, all the way back down to previous support because there's nothing left here before the COVID pre-pandemic highs. And all of this euphoria that happened after the market recovery, there's hardly any volume there. As a matter of fact, this giant area right here, this is one big air gap. There's no trading volume here, or actually all the way down to here, as a matter of fact. So this entire area in the market is just one giant air gap with very little volume. So it won't take very much once it breaks this level for the market to just go straight down in this fashion in a very short period of time. We've seen it try to do this twice already between the drop that happened in May and the drop that followed in August and September and culminated in the CPI market release in middle of October and then a big market reversal. So my expectation for the market remains unchanged that we're going to see this big rejection come down from here. So there is going to be a very rapid turnaround in the market, I feel, that will see us retesting this megaphone and probably re-entering it within about 30 to 45 days. By the time that comes around, we'll have gotten a second CPI report, which, by the way, if you missed it, the CPI report was actually pretty hot. If you look over to the right of my terminal, you can see that the inflation rate year over year and core inflation rate year over year both printed actual figures that were slightly above the forecast. The prediction from Wall Street was pretty much in line, but the forecast from the Fed, they were hoping for much lower numbers. So this disagreement between Fed and Wall Street is where we're going to see the market confirm this move. I'm surprised it didn't happen faster once this print came out. And this would make the second piece of news that we had gotten, which was quite negative between all of the bad earnings reports that we got from the top companies in the retail sector and also Apple's earnings report. All of these bad earnings combined with this increasing year over year inflation that was slightly hotter than expectations means that inflation's not coming down fast enough to satisfy the Fed. So our previous inflation was 6.5%. Our actual inflation now is 6.4%, means that we've barely moved. It's barely adjusted. It could even be a clerical error, and the margin of error on this can be as much as 0.5%. It can be a whole 50 basis points off. So there's no guarantee that this data is even accurate, and I would argue that it's not, because looking at the prices at the grocery store and gas, we can see and observe that across America, those prices went back up and people are still struggling. And that struggle is still going to continue going into the spring as the housing market is heating up and everyone starts listing their homes on the market for sale. The producer price index also came in hot. So the PPI, which indicates inflation for manufacturers or the product producers, was also slightly hotter. And this is also negative for everybody because this is going to affect the end product results or the margin of cost of sales versus the end sales price of finished goods. To put it into simpler terms, it's basically an increase on the price of raw materials that are necessary to create finished materials. So everything that you have between your food, your furniture, your car, all that stuff is by and large getting slightly more expensive. And it came in hotter than expected from the forecast, which they were hoping for that change month over month to go up only very slightly, but it almost went up by a full percentage point. They were hoping for less than half. Something else that kind of signaled things to me was that today the building permits details came out and the building permits showed that there is a bigger decline in building permits than expected. This I was pretty much expecting myself, that most of the home builders are really trying to liquidate inventory right now. They're not interested in building any new homes. So a lot of these are probably going to be private builders for the most part, although there are definitely still some areas of the market which are still seeing hot prices and demand for new houses. For the most part, the big areas in the United States have already sold they've already sold out to all of the buyers who were interested. So now the buyer's market has dried up and sellers are about to start pouring and pushing all of their inventory out onto the market all at the same time. We're in that perfect window. February is when it all starts, just as I mentioned, and all of the housing starts that are not coming in now is a signal that that the market is satisfied and the builders know this. So they're not going to be interested in building any new homes from scratch anymore. They're going to be focused on trying to liquidate their existing inventory and making buyers choose from what's available, what few there are. And at the same time, all of those home builders that already have inventory, there's loads of problems with the builds that they already put out there. So lots of complaints in the news lately about those builders who did a really shabby job putting new homes together, and people are calling in their homeowner's warranty and making them fix it. And some of these things are major problems down to foundational structural issues that could result in like the complete collapse of the home and even get people killed. So it's not a joke what's happening in the housing market, um, especially for the builders. They're about to see some serious pain. So all of this spells a lot of really bad news for the market overall. And looking at the heat map, you can see that everything took a huge hit today. Tesla, especially at the very end of the day, was pretty bad. If we go and look at Tesla, the look of Tesla was honestly pretty bullish up until they had announced some recent news that their situation had changed because of a recall. So this was pretty surprising news that hit the market very suddenly. There wasn't a very rapid reaction right away when the news hit, but when Tesla published that they were recalling approximately 362,000 vehicles, it was because their full self-driving beta software needed to be fixed and that there was potential for it to cause crashes. That by itself was probably enough to it was enough to scare the weaker investors. And the weaker investors that start selling their positions in a panic as soon as they see this will cause other sellers to come in and start piling on. The short sellers, especially the very ambitious ones like myself, already took positions in the market on Tesla when it started breaking above 210. This, for me, was a fundamental level that Tesla did not belong at because it was getting rejected right here by its 200 daily simple moving average. That's what this yellow line is right here. That is a daily moving average for 200 uh, daily candlesticks average for Tesla. So since it didn't even come close to breaking it at 225, I really had a feeling that it wasn't even going to come close. But that was what I was waiting for confirmation, was a big rejection, and we got it right here on this head and shoulders pattern that appeared at the very top of a big Fibonacci extension. And now Tesla's completed a head and shoulders pattern and broken down through the bottom. I already took my position right up here near the head of the market, and I just kind of sat back and waited. My positions are good until the end of March. So that's where I'm sitting for Tesla. And right now it's gone so far as to break its 200 period 15-minute moving average here after hours. If I go back to the daily, you can see that Tesla didn't even quite break above its 200 daily EMA. It's actually got quite a long way to go before it finds support all the way back down here at the 100 EMA. So that brings Tesla all the way back down to approximately $188. And I think that I'll easily hit my price target within the next month. That's how much time I'm giving myself. It's actually till the end of March, so it's more like 45 days or so, but you get the gist. Tesla, I believe, is coming down. On the daily candlestick chart, we have a hanging man candle, and that was pretty convincing for me. I didn't need much else to get into a position once I saw how we opened today. The break for 200 daily EMA was where I took my position and got into a short. So if you guys are also following this, another clue to this that this was coming was a leading MACD bearish crossover and the volume direction candles kind of flattening out. That was a good signal that indicated that this was starting to come down. And then finally, there was this little bearish divergence on the RSI. It's a little bit difficult to see, but this higher high in the price action and a lower high in the RSI, that was a divergence that I paid attention to. So on the daily chart, that was enough to convince me that this was a good entry, and I got in right at approximately, let me give my exact entry. It was right at 210 and 70 cents. So I got in as it was coming down and bouncing off of this shoulder level. So I didn't wait. As soon as I started seeing these candles, once it jumped back up above the 50 EMA, that's where I took my position. So not the perfect entry, but I'm happy with it. So we'll just see how that goes. I am still into my Apple short position, which is now starting to go green finally. This one I entered back into pretty far back, actually. I entered right at the beginning of these candlesticks when we had this big knife candle or spike candle, however you like to describe it. So my entry was quite early, but still very far away from my stop loss, and I'm quite comfortably positioned. Now that we're seeing this going into the green, all I'm kind of waiting for is for us to break this support, and we do seem to be doing so after hours. We'll see how Apple opens on Friday, and we'll just watch things unfold. NVIDIA had a very similar formation that is definitely worth paying attention to. I would consider this to be more like a just a falling three pattern. We had two attempts to break above resistance that kept getting more and more aggressive, and at the end of the day, it ends up looking kind of like a falling wedge. But when you put it into context that this is one giant double top pattern, I think that we're going to probably end up seeing this thing come back down to 212 pretty quickly. I think that it'll most likely happen before earnings, as a matter of fact. The earnings report I expect is probably going to see some pretty major volatility in NVIDIA, so it's going to be hard to judge in the near term. But my expectations for NVIDIA is that once the market starts running away with itself, even if for whatever reason the earnings cause it to jump all the way back up to its previous resistance, it'll just end up knifing back down. We'll get a giant inverted V or a chevron falling pattern, and that would complete a triple top pattern. So if we end up with something like that, one big triple top and then the market coming back down, NVIDIA will continue to the downside for the rest of the month is my expectation. For me, I don't even honestly think that NVIDIA will return back to this previous high. I think it'll probably just peter out, maybe reattempt to touch the 200 and then fall from there once we get the earnings report. Again, NVIDIA, as I've said in many videos previously, NVIDIA has been hemorrhaging money in their bid to create a new quantum computer in their partnership with Microsoft. And while it sounds really great on the surface, it's extremely expensive, and they don't really have that much capital that they're going to be able to keep doing that before they have to start taking on some pretty serious debt in order to pay for the cost of that. So that's my expectation, is that debt will come back to bite them once they start absorbing it. Netflix is currently fighting at a floor of support. It's still holding itself up just barely, so we're going to have to see what happens. But I do think that once Netflix breaks down this big knifing pattern here on this death spike on the volume direction candles for Netflix is kind of a sign of things to come for me. I think that Netflix will most likely return back to the range of 320 to 335 price range sometime within the next 60 days. So at some point, coming back down to retest this area and then probably range before it either comes back down even further or it reverses and then we get a new expansion contraction pattern. Amazon has already kind of had a giant reaction because of its earnings, so I'm not expecting too much of a fall from them in the near term. The expectations that Amazon wasn't doing well is already kind of settled into the market, so I am still bearish on it overall, but I'm expecting it to just kind of hover around this area of support. This is pretty strong support here at 95, $94. So it may take some time before Amazon gets moving in any direction in particular. And then finally, we have Meta Platforms. The earnings report for Meta really sent it roaring past its 200 daily EMA and simple moving average. That gap up was pretty spectacular. And now it seems to be working to fill the gap. The entry is still relatively early, so I'm thinking about a position and trying to get some of this as it comes back down to 155. It may take a month, and a lot of the move has already happened though, so I'm kind of just like thinking, it's probably too late to take a good position. It's a little bit of an expensive stock to try to short buy puts in. So this one, if you're already in a short position, then I would just let it ride and just see what happens for the next 30 days. But if you're debating whether to get into a position now, I would wait to see it break some levels of support and come back down even further, or for it to get through a chop period. It's kind of hard to judge where it's at right now. The gap does leave quite a bit of room for it to fall, but we don't know how long it's going to take, and most of the move has already happened, so prices of options are pretty overblown right now. Um, so just keep that in mind if you're debating a meta position to the downside or even to the upside for some reason, if that's what you think. The options on Meta are pretty damn expensive right now. And the last thing that I do want to go over is DRV. I've talked about XLRE, which is the housing ETF, but the DRV inverse three times bearish ETF that tracks the real estate sector is I'm expecting it to do extremely well. So I'm just going to focus on this one for the rest of this video before we close this one down. I called out very similar structures here during its first move in the end of August when the market was starting to get really shaky. The SPY had already had a huge dump, and we did capture a big move of about 30% back in August when things first started to take a big nosedive. But after this formation, the market came back down to retest it here, and then the market collapsed and DRV went to the moon after that. The span of time for this trade right here was only 17 days. So not even 1 month later, and DRV had ripped by 70%. It was insane. This ETF does extremely well when there's panic on the real estate side, and I'm thinking that that's going to be coming very soon. And that parabolic stepping up pattern of the market, like finding slightly higher and higher and higher levels to find support, is the sign that it's getting ready to make one of these styles of moves again. I think that it is because of big anticipation that the builders are going to announce some serious troubles in the housing market, and a lot of the real estate data providers are starting to be more honest about the situation. Interest rates, I also expect to start going back up again, and that's probably going to basically wash most of the remaining buyers out and let them decide for themselves that, hey, I don't think this market is one to be buying right now. I can probably get a better price if I wait a year or two. And that decision by itself, once that thought process goes mainstream, the rest of the market will panic and sellers will start to really feel the pinch because their opportunity to sell will have been officially missed at that point. So, as I mentioned, looking for these big knife down patterns in DRV. That happened back here in on the 2nd of February, and we, as you can see from previous similar moves, the move to the upside is rather explosive and happens very quickly. By the time you get the majority of this move happening, the cost of the options in DRV becomes so insanely expensive that it's not really worth the risk to reward. take that position. So, one classic signal of that I have found was a crossover on the volume direction candles. Once the volume direction candles go into bullish territory above the moving average, that's your signal. That happened back here at the end of August, right here where I mentioned in the last bear market or the bear market leg. And then before that was April, which was the first massive bear market leg. So we are just at the cusp of doing it again. It's right here. So very, very close to making its move. The entry, the time to make an entry was honestly several days ago, but there's still time to get an entry before the market responds to this. And I think that by the time people figure it out and we start seeing DRV at like $50, it's going to be too late to get a truly profitable position. Now is the time to enter before the market panic sets in. So, other things that you can do as a small trader to take advantage of moves like this are leveraged ETFs that are inverse to the market. SPXU is my personal favorite. And you'll probably notice that there's a very clear floor here that every time it touches this area, the explosive response that follows is hilarious and also extremely profitable. So, we just had a double bottom off of that exact move right here, and we're just now starting to see something very similar. So I'm expecting something like a anywhere from a 30 to a 50% move in SPXU within the next 50 days or so, and I have set my bets accordingly. You can again take note of the volume direction candles, and I'll say that again slowly. Volume direction candles indicator by JD on TradingView. You can use this to indicate when the market is ready to make a big move. You'll notice these big exponential or parabolic curve patterns of support happening on the volume direction candles. That is a very clear signal that the market is ready to make another big move, and it starts happening pretty early. So you can get in on these positions very early, but the other very clear signal is just the fact that it's crossed below this line or it's touched this line. All you have to do is just enter into a long position on SPXU when this market has touched this line at around $13 and just give yourself about 60 to 90 days on your position. And as long as we're in this bear market that is just absolutely pummeling people, that's a pretty good bet. It's also a very cheap bet. These options are very cheap, sometimes like $100 or less for at the money options that are more than a month away from expiration. You can get some pretty cheap positions here. So if you're a small trader that are looking for options plays that are very affordable, this is one of those possibilities for you. Just make sure you're doing your own due diligence and please don't risk any more money than you're willing to lose in the market because remember, I'm just a YouTuber and a human. I can make mistakes and you should probably be doing your own research, not just relying on myself. That being said, I am in a long position on SPXU, which is short on the SPY or the S&P 500. My expectation is for this to at least hit $16.50 within the next 30 days, and my price target, my very lofty price target, somewhere a little bit above $21 within the next 60 days. So that'll put me at about mid-April for that take profit. So that is my plan. Another option for you is SQs. It's basically the same thing, except it targets the Qs instead of the SPY. And of course, there is VIX and UVIXY. Both of those are also very valid leveraged plays that you can take a look at. I know I said I was going to focus on DRV for the remainder of the video, but I did also want to make mention of the yield curve right before we leave. We're still in deep inversion, just to point that out. So nothing has changed. The crash still hasn't happened yet. Every single crash happens after the inversion ends. So we still have yet to see the big one, you know, but we are getting a crossover on the Treasury curves. So that does signal that there may be potentially a reversal coming in the Treasury curve, and that could signal that a crash is coming very soon. We're just going to have to wait it out. Thank you guys so much for watching. I hope you found this information useful. If you did, please don't forget to leave a like on the video, subscribe for more, and if you would like to get access to myself and all of our analyst team at Hell's Trading Floor, please consider joining us at hellstradingfloor.com, where you can sign up for our Discord at discord.gg/Hell's Trading Floor. Thank you so much for watching, and I'll see you guys next time. Until then, have a hell of a time in the markets.